When I first started out investing, it was a daunting challenge to stock pick because I didn't have a framework to understand what I was buying. Between the different classes of stocks, business metrics, and the countless reports by financial analysts, it was overwhelming. Today, I have a slightly better understanding of what to look out for in a stock, and in this video, I'll share a simple framework which might help you decide which businesses to invest in. Coming right up. Before we jump into the details, do note that I am not a licensed financial advisor and none of this is financial advice. We're simply presenting our research and opinions for fun and educational purposes. The first thing you should know, if you're going to invest, is that shares are just tiny fractions of an underlying business. The stock market can be extremely volatile because it's basically a financial game where both humans and bots play. Traders are those that play this game on a short-term basis, for example, trading shares based on the daily or the hourly chart. However, to be a long-term investor, fundamental analysis of a company is more helpful. To do this, we need a mix of quantitative and qualitative analysis. Qualitative analysis is to look at the X factor of a business, aka its secret sauce, aka its economic moat. What makes it superior to its peers? Is it due to barrier to entry from government regulation? Is it a household brand? These may be non-quantifiable attributes of a business, but they are super important because the numbers don't matter if the company can be easily replaced, disrupted, or made redundant through regulation. Quantitative analysis, on the other hand, is very simple. You look at the financial statements for the company, the top-line revenue, as well as their earnings, and declare a company expensive or cheap based on their price-to-earnings multiple, the price-to-sales ratio for a non-profitable company, among other metrics. If these terms are confusing to you, not to worry. We'll be creating more videos to explain how to compare and interpret these financial metrics. Let's use Meta platforms, formerly known as Facebook, as an example of a business we want to understand. Let's start with a quantitative analysis since that data is readily available and doesn't require that much research. As of filming this video, Facebook has a forward-looking price-to-sales multiple of 24. Relative to some of its peers, Alphabet with a 27 times multiple and Twitter with a 200 times multiple, Facebook is trading at a discount. Top line revenue growth for the past 5 years is 36%, which is fantastic, even when compared to other high-cap tech companies. They have no outstanding long-term liabilities and are sitting on a healthy $58 billion of cash, which can be used to buy back shares, reinvest back into the business, or pay dividends. All in all, they have a fantastic balance sheet. Moving on to the qualitative side. The biggest thing that comes to mind is Facebook's brand. On one hand, they are difficult to disrupt because they already have the largest social network and have acquired both Instagram and WhatsApp. It will not be easy to replace Facebook, Instagram and WhatsApp, even if a competitor has a superior alternative because of the network effect. Each user is likely to attract their friends into the platform, and we can observe that social media and instant messaging has been ingrained into people's lives. However, Facebook is also vulnerable to the likes of Apple, who can easily decide to remove Facebook's app from the App Store to protect Apple users' privacy. More crucially, Facebook also has a history of scandals. For example, the Cambridge Analytica scandal between 2015 and 2018, and the whistleblowing incident that led to Zuckerberg being called to testify at Congress. So we have a company that has been accused of interfering with elections, knowingly inciting violence through its algorithms, and potential scrutiny and regulation coming after them. In this case, I feel that the discounted price of Facebook stock is justified. Whether it suits your portfolio as an investor depends heavily on your views on how they will navigate the shaky image of whether public trust in their platforms can eventually recover. If you think the lack of trust is enough to erode their earnings over time, the next question should be, how much of a discount for Facebook shares do you need to have a high probability of making money on the stock? In my opinion, the fact that these scandals were nowhere close to destroying their businesses shows that the economic moat they have is perhaps even stronger than most people think. Full disclosure, I do not own shares in Facebook at the moment, but it is on my watch list and I may change my mind if they trade at a further discount. Generally, We use this approach of fundamental analysis to decide which stocks are a worthy investment. Of course, sometimes not all the information is completely clear, and that's where you have to speculate a little and ultimately decide as an investor how much risk you are willing to take on. Now, we'd love to hear your thoughts. How do you balance qualitative and quantitative analysis of companies? Which is more important to your investment decisions? Let us know in the comments down below. If you're interested to hear more from us, subscribe to our channel to get notified every time we release a new video. Gently tap the thumbs up button for the almighty YouTube algorithm, and if you find this helpful, share this with your friends and family. We will see you in the next video.